Hey, welcome back to the Lee-Chandler Commercial Finance Podcast. So today we are going to talk about something that might be on your mind. All right, I'm going to give you guys a few market updates. We'll talk about the Federal Reserve, particularly out of St. Louis. That chairman wants you guys to know something important, and then ultimately I want to explain what's going on with retail investors. All right, so let's get started. So as of right now, you are probably aware of the pandemic, and some people are calling this the quote unquote post-pandemic. It seems almost like someone snapped their finger and the very next day everything was post-pandemic. So I can't really tell you where that started or stopped. What I can tell you all is that the pandemic has become somewhat of a scapegoat for larger companies. And I'll tell you guys how this all ties into commercial finance at the end. But let me give you guys some updates. Some of you all are familiar with SoftBank. If you are aware of Cash App or other digital banks that are popping up, SoftBank was one of the first, and they're having problems with some executives in China. You know, what that ultimately has to deal with is that their failure of IPOs. All right, so keep that feather under your hat. So in reference to IPOs, as we all know, when it comes to commercial finance, the IPO is what allows the company to really make its largest gain because, you know, different underwriting based off of EBITDA, et cetera, turning, you know, $1 of pre-profit into possibly 300 times that amount, all right? Or 30 times that amount just off of an IPO. So all these things are connected, and I'll explain in a little bit. So right now we have inflation that is technically rising, right? The index obviously has risen. We have stocks that are in many cases dipping. We have treasury bonds that are also not looking too well at the present moment. However, it's causing people to believe that in the future, short-term future, 5-10 years, that it will increase. What that is causing people to do is it is causing people to liquidate, to leave treasury bonds. Okay, it's causing people to leave treasury bonds. So that's another feather under your hat. All right. So government bonds are basically being considered as trash at this point. So the market is responding to what's going on, and essentially they, as far as the short term is concerned, there is less confidence in the governments, basically. So people are not willing to bet on the government. You have different areas such as, you know, the European Central Bank, which is claiming that interest rates within a 24-month time frame will decrease or basically be a minus or sub 1% or 2%. We have the Federal Reserve out of St. Louis that is suggesting that interest rates need to rise 1% within the current calendar year. So what would that look like if all these things are true? It would mean that within 12 months, interest rates would raise 100 basis points or 1%. It would mean that within 24 months, supposedly, interest rates would actually drop 1 to 2%. So either we're basically will be in the same exact area, or we'll have a lower interest rate. Okay. Now here's what's interesting for quote unquote stock investors, people in the stock market who like to call it equities, right? So equity investments have not been as volatile as they are right now since 2008. And going back to the IPOs and going back to the mentioning of the dip earlier with treasury bonds and stock market, it's causing investors, quote unquote, retail investors, to exit treasury bonds. So people are afraid of treasury bonds at the moment, and they're so afraid of where they can put their money that they're automatically just putting their money into the stock market. Now, I want you guys to think about this. Treasury bonds are dipping. The stock market is dipping. People are choosing to take their money out of treasury bonds that are dipping and to put it into the stock market. Okay? So that's how all this is tying in. Now, what's interesting is that 56% of Americans, as of right now, per the Gallup poll, 56% of Americans are basically investing in the stock market in some shape or in some fashion. All right. Now, retail investors, individuals who are non-accredited, non-professional, they could possibly work, someone who works a full-time job and then also happens to, be a day trader in the morning or a day trader at night or whatever else. They come home, they trade in the stocks, or maybe they're on their phone and they're trading stocks the same way that they gamble on an NBA or NFL basketball game. All right. That has risen. So 20 years ago, as a percentage of households, 10% of someone's wealth who was active in the market, 10% of their wealth was actually the stock market. Today, it is 27%. And I would just say round up. 30% of their wealth is basically in the stock market. Okay? So we want to think about that for a moment. As fear is increasing in the overall economy, more and more people are becoming frantic. You have inflation, we have hyper prices, we even have stock prices increasing super high, right? Inflation's everywhere. And so people are saying, hey, I'm just going to put my money in the stock market. Now, what's interesting to me is I want you guys to think about this. Whenever economies are doing poorly, the primary thing that saves economies is war. All right, you can just review history. The thing that saves economies is war. The second thing is that there's normally some type of reset for a currency, and so that could mean that we could possibly go into a currency reset via, let's say, maybe the Fed coin or the Chinese cryptocurrency, right? But it's not going to be Bitcoin itself, because Bitcoin has a limited supply. Therefore, it's more of like a collective item. It's not an actual currency. So keep that also under your hat. What we're seeing is, because most people are not aware of alternative investments, out of panic, they're viewing the stock market as the only solution or the only game in town. This is why it is so important to understand how alternative investments work and their benefits. Because even if or when someone does choose to hop in and out of the stock market, like a shower, right? Like a cold shower, actually. And even if they do make proper gains, they're still going to be hit with a large tax bill. And ultimately, that could, especially if someone has a W-2 income, that could perpetuate them in a worse condition than where they are, a worse financial position than where they are right now. So it's important right now, especially right now, that you understand alternative investments. If you want to still put your money in the stock market, that's fine. You can allocate that. That is A-okay. But you don't want to have too much exposure. If you already know that it's volatile, then right, that it's volatile. Therefore, you expect a change, and therefore you may expect a loss. But you don't want to be overexposed. You don't want to be exposed to where, if there is another dip, right, if things do get worse, if bonds do continue to sink, that if that's a majority of your portfolio, it's going to hurt you, and it's going to be detrimental to your financial stability. All right. So if you guys have any questions, let me know. I hope this information really helps you out. Ultimately, this is to strengthen you all in your financial journey. Remember, commercial finance is one of the gateways to financial freedom. All right. With that being said, thank you for listening, and we'll talk to you soon.